Hey, can you guys hear me now? Is it working now? Oh, okay, cool. Sorry, I had a bit of an issue with. This is why we started 2 minutes late. My mic wasn't working. Then I plugged it back in, and it seemed to be working, but then you guys still couldn't hear me. So I don't know what that's about. Anyway, guys, we'll just take this one from the top. We were only 30 seconds in. Uh, Thankfully, someone was able to get my attention, so we can just dive right back in. Sorry about that. Sorry about the late start. Just having a few technical difficulties. I don't know what's up with my mic. It was working fine a few days ago when I last did a webinar. But anyway, we're already late, so I'm just going to dive right in. Let's get started, guys. So, in today's webinar, we're going to be talking about the free best setups that you can trade in 2020. So, what are you going to learn? First, you're going to learn what the market will most likely do in 2020 and why. So, what it's most likely going to do in terms of volatility, trends, ranges, setups, all that kind of stuff. I'm going to be talking about what it will most likely do, but I'm also going to show you why I think it's going to do that. Next, I'm going to be talking about how to put together a solid trading game plan. And this is applicable for every single year. I'm going to teach you how to put a plan together every single year, not just for this year. So I'm going to show you the actual process of putting a game plan together. A game plan is really important because it helps you focus on the right trading setups and the right trades. It also helps you to know what to expect so you don't get any surprises. Now, with trading, there can always be surprises, of course, but having a game plan allows you to kind of prep for those surprises and to just be aware of everything that can come up. So I'm going to show you how to put together a game plan. Then we're going to talk about the three most powerful setups that you can trade in 2020, the title of the webinar. These setups are based on the game plan. I'm going to show you exactly how to trade these setups too. It's not just, oh, you can trade this setup and not explain the actual setup itself. And I'm going to explain why I think they are the most powerful to trade in 2020. The cool thing about these setups is they can all be traded no matter how little free time you have. They can be traded on lower time frames, such as the 4-hour, or larger time frames, such as the daily. So they'll fit with anybody's schedule. Now, one of the setups is better on the lower time frames, but we'll get into that we'll get into that when we talk about the setup. So by the end of this webinar, you're going to know exactly what market conditions to expect in 2020 and the best setups that you can take advantage of in those conditions. So let's talk about the rules real quick. I just want to go over the rules just really quickly because we have a few rules and it just makes things run a whole lot smoother if everyone follows the rules. So rule number 1, don't be rude or disruptive. That's a very simple one, guys. If you can't do that, then someone's going to kick you because there's a moderator in here who will just kick you. So don't be rude or disruptive. I'm sure everyone can follow that. Number 2, keep your questions until the end. This is an important one. I really don't like answering questions throughout a webinar. I used to do it, but it ruins the flow, guys. Just keep your questions until the end. I'll be doing a Q&A at the end. And number 3, do not spam. Even at the end, if I don't answer your question, it's not because I'm ignoring it. It's because there's a bunch of questions before yours that I need to answer, and I'll eventually get to your question. If you keep spamming the question in the chat, like a lot of people do, probably just going to end up not answering it because, you're breaking the rules. So please do not spam, and obviously do not spam Forex products, blah, blah, blah. But that one should be pretty obvious. Anyway, let's get into the actual webinar itself. So let's talk about a game plan. How do I put together a game plan? Putting together a game plan for the year is pretty easy. Usually what I do is I wait until February, which is where we're at now. I don't do this in January because January is a bit of a weird month in trading. Things are just kind of, the first 2 weeks of January are pretty much untradeable, or at least the first week. The second week, you can kind of trade it, but it's really tough. And then the last 2 weeks or 2.5 weeks of January, I just like to get a feel for market conditions. So I always do my game plan at the start of February. So my game plan, the process for making my game plan is pretty simple. Number one, assess expected market conditions. Number two, plan on how to trade in those conditions. And number three is obviously execute the plan. It's simple and effective. So let's start with assessing what conditions we expect. Oh, oops. I went to the wrong slide. I need to switch over to my charts, which I'm going to do in a second. Just figure out how to do this easily. I haven't done one of these kind of multi-screen webinars in a while where I have to use like a bunch of different monitors, so I'm a bit slower than I normally would be. Right, okay, cool. I can switch over to my charts. Can you guys see my charts? You should be able to see them any second. They should be popping up. Yeah, they should be on your screen now. So if you guys could just confirm that you can see them. I just don't want to keep going if there's, you know, a technical difficulty again. All right, awesome, thanks. So if you traded in 2019, you'll remember that 2019 was a year of pretty heavy ranges and overall very low volatility. So it was extremely low volatility. It was one of the most low volatility periods we've seen in a very long time, since at least 2014. And beyond the low volatility, average daily ranges were also low. We'll get into average daily ranges in a second. But yeah, 2019 was a year of ranging and low volatility. And this is mostly due to the fact that there was a lot of fear in the market. Mostly this was prompted by the Chinese trade war, and Brexit also had a bit of an impact on the euro and obviously the pound. But both these things are now kind of over. Brexit is kind of over. You know, it's done in a sense. Now we're just waiting on a deal. Well, not a deal, but the fine print to be sorted out, essentially. And the Chinese trade war, a deal has been signed, so that's over. So a lot of fear that was causing very tight ranges in the market in 2019, we probably won't see that anymore leading in, moving into 2020. On top of that, on top of the fear and the tight ranges, the market was hitting some pretty extreme levels on a lot of the majors and a lot of the cross pairs too. So by extreme levels, I mean the market's been at major lows. So this is a daily chart. Let's switch to a weekly chart actually, because it better illustrates this. So weekly chart here on AUD/USD. You can see that price is still at a major low, and it was at this major low for most of 2019. 2019 AUD/USD was at this low, and this low has not been hit since 2009. So pretty significant low. Euro/USD wasn't quite at one of the lowest points it's been since so basically Euro USD for most of last year it was sitting around here, which is sort of in between the range that we've seen in the last decade, or the last 5 years at least. GBPUSD, this was at some crazy lows that we haven't seen in, since the 80s or something like that. It's starting to climb back up now, but it spent a lot of last year pretty low, especially towards the middle / end of last year down here in this area. So we were seeing some pretty extreme lows on a lot of pairs. New Zealand USD is another example. It was towards the real bottom of the range that we've had in the last 5, 6, 7 years. USD CHF, this one was, I guess not really at an extreme low, but nor was it at a high. But my overall point is that we were at these pretty extreme levels last year on a lot of the majors. Not all of the majors, of course, but a lot of the majors. We were at some pretty extreme levels. And usually when you get price moving to these extreme levels, they tend to pull away from it. There's pretty much, the way to think about it is there's more room on the upside for AUD USD. There's more room for it to move up than there is for it to move down, because it's going to struggle to move a lot lower than this. And the same goes for Euro USD, the same goes for GBPUSD, and especially with Brexit kind of dealt with, GBPUSD, we could see it climbing back up. So the way I see it is we're going from a period of tight ranges because of fear, and because price was at extreme levels. We're going from a year of tight ranges to potentially a year of pretty decent trends. That's what I'm expecting to see this year. I'm expecting to see a fair bit of trending in the market. And with trending usually comes volatility, so I'm expecting to see a little bit more volatility. But I'll explain the volatility a bit more in a second. Let's jump back over, Let's jump back over to right, so another key factor in assessing what the market's very likely going to do this year is average daily ranges. What is a daily range? A daily range is the difference between the highest and lowest point price reaches in a day. The average daily range for 1 year is every day's range, every trading day's range for that year averaged out. Average daily ranges are important because they are linked to market volatility. A low average daily range usually means low volatility. So I've calculated the average daily range for every major pair since 2006. Well, I've done it since actually a fair bit before 2006, but the chart I'm going to show you only goes back to 2006. So yeah, I calculated the average daily range for each major pair for every year. The chart shows it since 2006. I then got the average range for price across all majors for each year. And I know that sounds a bit confusing, but basically what this is how much the market is moving on average for all the majors in pips. So you'll see that back in 2008, market volatility peaked by a crazy amount. It shot all the way up to 165. Then in 2009, it was at 155. So that's how many pips on average it's moving per day between the high and the low of that day. So it's a pretty significant number, that 165, 155. But obviously that's back in 2008, 2009. Right now, it's nowhere close to that. Nowhere close to that. So the highest we've seen in the past well, since around 2010 is 122, 118. And then we had a bit of a peak in 2015, 2016, which was 109, 104. So this is important because this shows us essentially how much volatility there is in the market right now. 2019 was actually an all-time low. And like I said, I'm pretty sure that's because of Brexit and because of all that kind of stuff. There was a lot of fear in the market, so there wasn't as much trading. Low volatility isn't necessarily a bad thing. Actually, I kind of like low volatility markets. Uh, but yeah, last year's volatility was a bit lower than even I like, to be completely honest. I'm expecting volatility to pick up significantly this year. A lot of the times with volatility, what you see is it dropping to pretty extreme lows for 3 years, and then it picks up again after that. So this can be seen if you look at 2012, 13, and 14. This period here, it dropped down pretty low, then it spiked up after that. And if you look at 2005, 6, and 7, this doesn't go back to 2005, but volatility was low in 2005, 6, and 7, and then it shot up again. So it's a pretty kind of common pattern where volatility really drops down for a 3 year stretch and then it pops back up again. So I'm expecting to see a similar pattern. Also, like I said, the fear being removed from the market with Brexit and the Chinese trade war. I think we're going to see a bit of a spike in volatility again. And that really affects the pairs that we're going to trade, because the more volatility you have, sorry, not the pairs, I meant the setups. It really affects the setups that we're going to trade, because the more volatility you have, the harder it becomes to trade setups that rely on ranges and that rely on counter trend, and the easier it becomes to trade setups that are following strong trends and that are breaking out of certain support resistance areas. So that's why average daily range is important. I'm expecting to see a pretty decent spike in average daily range, perhaps back up to 109, 104, something like that. And that's going to be quite significant. And we've already had a pretty big spike already in January. So it's looking like it's happening already. But anyway. Oh yeah, I just wanted to say one more thing before I talk about the setups about low volatility. Now, a lot of people see low volatility and they think, oh no, the Forex market's dying. There's low volatility, blah, blah, blah. It's going to suck to trade it. But low volatility is actually not a bad thing at all. Trading low volatility is much easier because there's less violent and unpredictable swings. While it also means less pips, that doesn't really matter because the value of a pip is relative to the risk. So in lower volatility markets, you're making more per pip than you are in a higher volatility market. So the amount of pips is really insignificant because you just risk more per pip and make more per pip. So I prefer lower volatility markets, to be honest, but there are some benefits to higher volatility, which I believe we're going to see in 2020. First of all, higher volatility usually means your targets are going to be hit a whole lot quicker, and less time for your targets to be hit is actually pretty good because it means you can usually catch a lot more trades. A common problem that traders face is that they'll be in 2 or 3 trades and they won't want to open a 4th or a 5th trade. And in low volatility markets, you can be in those 2 or 3 trades for a whole week. In higher volatility markets, those trades will usually hit target a whole lot quicker. So you'll be able to exit those trades and get into other trades. So there are definitely some benefits to high volatility markets. Also, higher volatility means that it's easier to extend your targets and make more profit on a trade than you originally set out to make. So let's say your target was, just for example's sake, 100 pips. Once it hits 100 pips, it could be moving so fast that you can extend it to 150, maybe even 200. So like most things, there are pros and cons. And that's why we need to prepare, so we can negate the cons as best we can and we can accentuate the pros. So let's actually talk about how we can prepare. And to do that, we're going to check out some charts. So I need to switch back over to the charts. Give me a moment. Okay. Sorry guys, I'm not sure what's happening with my software right now. Yeah, I'm having trouble switching to the charts. Yeah, let's not worry about that. We'll go to the chart. We'll go back to the charts in a second. I'm really sorry, guys. I don't know what's happening with my software. It was working fine the other day, and now it's being a bit weird. But I'm sure I can sort this out in a second. I just want to kind of keep the flow going, so I'll go back to my charts in a bit once I figure this out. But let's talk about what to actually expect this year. So my game plan for 2020 is pretty simple. I'm going to expect trends. So I'm going to focus on trend following setups. So why am I expecting trends? I've kind of already explained my thinking there. Basically, we're seeing price at extreme levels, and usually when price hits extreme levels, there's a pretty good chance that it's going to turn around. Ooh, there we go. Now they're up. Nice. So my charts are up. So yeah, expect trends. Why am I expecting trends? Because here is GBPUSD. It's a pretty good example of what I'm talking about. GBPUSD recently hit lows that it hasn't seen since 2016. But before 2016, these lows hadn't been seen since the 80s, or maybe even ever. I think these were all-time lows. So GBPUSD was at some very, very extreme lows, and it hit those lows again towards the end of 2019. So like I was talking about with AUDUSD earlier, when price hits these extreme lows, it basically means that it's very difficult for price to get below these levels. But there's a lot more room on the upside for price to move. So on the bullish side, there's a whole lot more room for it to move. It's going to be a lot easier for price to go up than it is for price to go further down. Now, there's always this thing in trading when you start to try and predict market lows, and you kind of trick yourself into thinking it can't go any lower than this. So that's not what I'm doing here. I'm not saying that it can't go any lower than this level. I'm just saying that it's harder for it to go lower than it is for it to go higher. That's all I'm saying. And because of that, what I think we're going to see is we're going to see a trend back up to the higher levels that it was at pre the Brexit vote. Now that Brexit is kind of dealt with, we're probably going to start to see a push up. AUDUSD, very similar situation. It's at lows that it hasn't been at since 2009. So these are very, very significant lows. It looks like it's dropping right now, and it could very well continue to drop. But again, it doesn't have as much room to move on the downside as it does on the upside. So it's likely that we're going to start to see a trend back up this year. So this is why I'm expecting trends. And this is not just on these two pairs. It's on a lot of pairs. New Zealand USD is another example. A lot of pairs we're at these extreme levels, and it's likely that we're going to see trends moving away from these extreme levels. So that's why I'm expecting trends, and I'm going to be focusing on trend following setups. Whenever you get, that's supposed to say trends, sorry about that, guy. Whenever you get trends, there's also going to be some pairs that inevitably are going to be ranging. Some of the cross pairs are going to be ranging. So we should also look at some range trading setups, but that's not going to be the main focus. The main focus is trends. Volatility is most likely going to be medium to high. So we don't really want to counter trend trade on heavy trends or on large time frames. We don't want to be, trading against the trend on the daily chart if we can avoid it. You can do it if it's not a heavy trend, but if it's a very heavy trend, you don't want to be counter trend trading on the daily chart this year if it's trending like I believe it will. Also, medium to high volatility means price is usually going to hit your target a lot quicker and go beyond your targets. So we want to focus on extending trades, extending targets on good trades this year. We didn't really do much of that last year, and the reason we didn't do that last year was because the volatility was so low that it was hard for price to even hit your first target, let alone extending your targets. There were a few situations where we did do it, but it wasn't as common as it would have been like a few years ago when we had higher volatility. But this year, I'm expecting high volatility, so extending targets is going to come into play a whole lot more. And finally, politically, things have calmed down. And the only major events on the horizon, aside from this coronavirus thing that could get pretty big, but probably not, it seems like it's very overhyped at the moment. So the only major events on the horizon are like, I don't know. Sorry, guys. See, the thing is with webinars, I'm really bad at doing webinars. I'm good at the content of webinars, but the whole like setup and the changing screens and the getting the spelling right and just getting the general grammar right, it's really not my strong point. So that sounds kind of stupid. Horizon, I like the US election. Obviously, that like shouldn't be there, but it doesn't matter. So the only major events on the horizon are the US election and Brexit finalization. And those are both going to be towards the end of 2020. So I think we have pretty clear sailing for most of this year. I don't think we're going to see much as much fear this year as we did last year. Now, the thing with politics is, things can always pop up. You never really know. But from what it looks like right now, we got pretty clear sailing. And also, of course, the US election, it is at the end of this year, but obviously the campaigning is the campaigning, I think that's what it's called, is going to be throughout this year. And that can cause a few hiccups in the market. But it's unlikely that it's going to cause the level of fear that the Chinese trade war caused and that Brexit has been causing. So this is my game plan for 2020. I'm not expecting any major political things. I'm expecting medium to high volatility. So I'm not going to counter strong trends. I'm going to be extending my targets whenever I can. And I'm going to be focusing mainly on trend following setups. And as a secondary, I'm going to be focusing on some range setups for the few pairs that I believe are going to be ranging. So what does this actually mean? Well, the three setups I'm going to focus on are trend continuations. Trend continuations are one of the best ways to capture strong trends. I'm going to be focusing on breakouts. This is a new type of setup that I'm going to be adding to my strategy. They are, I would say that they are the easiest and most profitable setups. but they are new to my overall strategy. So if you're familiar with my strategy, they might not be as easy for you personally because they're going to be new to you. But once you learn them, they are the easiest and they are the most profitable setup. In all my testing, I found that they are the most profitable setup in my arsenal. And counter trend reversals, we're going to be doing on smaller time frames. Or if we do it on larger time frames, we're going to be doing it on very weak trends. And I'll explain that more in a second. Well, when we get into it, I think they're going to be very, very reliable on smaller time frames. Counter trend reversals, smaller time frames. I think they're going to be awesome to trade on those time frames. But yeah, I'll jump in. I'll explain exactly why. I'll explain each of these setups in detail. So let me switch over to this. Yeah. So trend continuations. Trend continuations are one of the simplest types of trade setups. They're pretty straightforward. Essentially, you're just following the trend. That's what a trend continuation is. You trade trend continuations from support resistance areas. I'm not going to be explaining how to place support resistance areas as that's going to take a whole lot of time to do. However, next month I'm going to be doing a webinar series in which I'll be discussing support resistance. So if you don't know how to place support resistance, I'll be discussing it in next month's webinars. That being said, there are also a lot of recordings on my YouTube channel about placing support resistance. I've got a lot of videos on it, so you could also watch some of those recordings and learn how to place support resistance. So continuation trades are traded off of support resistance levels. There are a few rules to continuation trades. Number one rule is that you always want to trade in the direction of the major trend. If you're not trading in the direction of the major trend, it's not a continuation. Continuations are traded with the trend. So what is the major trend? The major trend is the trend that's happening on the daily chart. So basically, you want to look for the daily chart trend. And if the daily chart trend is, for example, bearish, then you want to take short continuation trades. How do continuation trades work? They are pretty simple. Once price breaks through an area of support, in the case of a bearish trend, once price breaks through an area of support, like we see here, then it pulls back up to resistance, because support becomes resistance when it's broken. It pulls back up to former support, which is now resistance, and it stalls out on that resistance area. We look for a short trade in line with that trend. Now, obviously, if it's a bullish trend, we're looking for a long trade in line with the bullish trend. But in this case, in this example here, it's a bearish trend. So we're looking for a short trade when price breaks through support. And I'll show you some real chart examples, some real trade examples. When price breaks through support, pulls back up to resistance, hits the resistance area, and then continues down. That is a continuation trade. It's a trend continuation. It's a very, very simple and very powerful setup. So I'm going to switch over to my charts and I'll show you exactly how I trade these setups, and I'll show you a few examples. All right. Hopefully it works fine this time. Yay, it does. All right, cool. So trend continuations. Let's start with 2019. I know, ideally, I like to show you guys a lot more recent examples because recent examples are always better. But the reality is 2019 wasn't a year of big trends. It was a year of pretty a lot of ranging. So it's hard to show you a lot of recent examples. Now, GBPUSD, I was able to find some recent examples, which I'm glad I was able to do. But as we go through the other pairs, a lot of the examples are going to be mid 2019 or earlier than that. So we'll start with this mid 2019 example, and I'll show you how continuations work. So continuations, they can be traded on. Actually, let's switch back to this. Continuations can be traded on most of the higher time frames. They're best on the daily, but they're also valid on the 4-hour, 6-hour, 8-hour, and 12-hour. They're valid, like I said, only on pairs with a strong daily trend. You trade only in the direction of the trend. Always try to extend your target. Move your stop loss to break even after 2R. Now, I'll explain that in a second. And pullbacks are the best place to enter. So switching back over to my charts, I'll show you exactly how I trade them. Starting with this example, let's actually put a vertical line here so we can easily find it. So this this continuation could have either been traded on the 12-hour or the 8-hour. A lot of the setups that I trade, you could trade them on multiple time frames. So this one, like I said, 12-hour or 8-hour. Now this one's a bit of a interesting one because price came up to this resistance area twice. So let's switch back to the daily actually, so I can show you the overall trend. So the overall trend on GBPUSD was bearish. You can see it was a pretty significant bearish trend. So in a bearish trend, we're looking for short continuation trades in line with the bearish trend. And what we're looking for is for when price breaks an area of support, which is this area here, price breaks an area of support, we're looking for it to push back up to support, stall out there, and looking for a short trade from there. Now, there were 2 points at which price pulled back up after breaking support, pulled back up to resistance and stalled out on resistance. So going back to the 8-hour chart, we can see both of these instances. Now, the first one, it didn't really give us a tradable setup because price never really gave us a good entry. So this one was just completely written off. The good setup came with the second push up to resistance. Now, price broke through. Price broke through, came up, then it came up again. Now you can trade continuations on the second bounce, that's fine. So price pushes up to the resistance area after breaking it as support, because like I said, support, once broken, becomes resistance. So the support area was broken, it's now become resistance. Price pushes up to the resistance area. It hits the resistance area and it stalls out, giving us an indecision candle. An indecision candle is kind of an umbrella term for all these kinds of candles, dojis, spinning tops, shooting stars, hammers. It gave us a candle that would suggest that price is stalling out at the resistance area. That's what this candle suggests. So once I saw that indecision candle, I knew there was a good potential setup here. Honestly, I can't remember if I actually traded this one because it's such an old one. I can't remember if I actually traded this one. So when I say I saw a setup here, don't take it as if I actually took this trade because I can't remember if I did. I like to always show examples of real trades that I did take, but when we have to go back to 2019, etc., like to like 6, 9, 10 months ago, I'm not going to go back into my trading journal to see if I actually took this trade. It's just a great example of a setup, so that's why I'm sharing this one. But I'll also show you some real trades that were taken. But yeah, this particular setup is pretty simple. You put your entry below the low of the indecision candle, you put your stop loss above the high of the indecision candle, and you put your initial target at 2R. So 2R is basically just your target is twice the size of your stop loss. Once that 2R target is hit, you can move your stop to break even. Or you can, depends on the rules you want to implement, if you want to keep a bit of a wider stop, which will protect you in scenarios like this where it retraced. If you want to put a bit of a wider stop, you can move your stop to half of its original size. I tend to follow the break-even rule, but it obviously depends on the scenario a lot of the times. If you follow the break-even rule with this specific setup, you could see that price would have shot down, hit your initial target, and if you had decided to extend your trade from this point, you wouldn't. You would have already extended it. You would have moved your stop to break even, and then you would have got stopped out with zero gain on this trade. So it all depends on how you would have traded this trade. Had you set your target at 2R and not extended, you would have hit your target. But the point is, this is just a pretty simple trend continuation setup. The reason we always want to try and extend our targets on trend continuation setups is because we're trading with the trend. And when you're trading with the trend, it generally pays to stay in a trade longer. And you can see with this example, had you been able to stay in this trade longer, you could have rode the trend down quite a bit and made a pretty big return on this trade. So trend continuations, it pays to stay in them a little bit longer. So that's just one example of a trend continuation. Let's look for some other examples, this one here, which are a bit more recent. Now, this example is from the end of 2019. I did not take this trade personally, but a few of my students took this trade. I wasn't trading around the end of 2019 because I was just taking a few weeks off. So I didn't personally take this trade, but this is a trade that was in fact taken by several of my students. So it's a pretty good example setup. I always like to show trades that were actually taken by me, or at the very least were taken by some of my students. So the previous one wasn't. Well, it could have been, but I'm not sure if it was. But this one was. Again, this is on the 8-hour, but this one could have also been traded on the 12-hour or on the daily if you really wanted to, but it was probably better off being traded on the smaller time frames like the 12-hour or the 8-hour, because you would have ended up with a better overall entry and setup. So this is a pretty simple setup. At this point in the year, the trend had turned on GBPUSD. GBPUSD had started trending up. You can see on the daily chart, it's clearly trending up. So GBPUSD had started trending up, and we were looking for bullish trades in line with the bullish trend. So we're looking for bullish continuations. So far, I've showed you bearish continuations. This is a bullish continuation. So this is how it works. Basically, price breaks through resistance. This is the resistance area here. Once resistance is broken, resistance becomes support. Now we're looking for price to pull back to support for a long trade. Now, one thing to note about continuation trades is that price doesn't need to immediately come back to support and then continue up. It could happen over the space of a week, even 2 weeks, and it can move up quite a way before it pulls back. So this one moved up quite a distance before it fell back to the support area, stalled out on support, and then started pushing up. So this was again, a pretty simple and straightforward setup. Price hit the support area. We got indecision on support. The entry was placed here. The stop loss was placed roughly here. Now the stop loss went below the low of this candle because this was the most recent low. We always try to place our stops beyond most recent lows. I'm not going to get into too much detail about the entry criteria because, again, that's something I've discussed in countless webinars last year. So I want this webinar to be more about the setup itself and less about, placing support resistance and entry criteria, because that's been covered in great detail in other webinars, which I'll link to below this webinar so you can view them and get a better idea of how I enter trades. But this was a pretty simple entry at the high, stop loss at the recent low, which was here, and it had a pretty decent target of 2R, which could have been extended a little bit, but not too much in this case, because as you can see, it reached about, well, actually that's pretty, yeah, that's pretty big actually. It reached about 4R, which is very, very, very good. So yeah, you could have easily extended this and pushed it to 4R. Usually 4R is about the limit I look for. So when I've made 4 times the size of my stop loss, that's when I pull out of these trades. So this one would have made it just to 4R, just a bit beyond before pulling back. So that's a pretty solid setup. Let's move away from GBPUSD, and there was a few examples on Euro GBP I wanted to show you guys. Right, so Euro GBP. I'm going to show you guys some bad examples, some failed trades, and what happened to my Euro GBP examples? Let's just go to New Zealand USD. Seems like some of my Euro GBP examples got wiped out, which is strange. We'll just look at this Euro GBP example and then we'll switch to New Zealand USD. So Euro GBP, towards the end of the year, it was trending down pretty heavily. We could see this very, very strong bearish trend. So in this case, we were looking for some bearish continuation trades. And we got a continuation trade here, again, towards the end of December. Now, again, this one was traded on the 8-hour chart, smaller time frames, and again, this one is not one that I entered personally because I wasn't trading at this time. I wanted to show you guys examples that I entered personally, but most of these examples are, how do I explain this? Basically, I wanted to show you guys the most recent examples possible, right? The most recent examples, but I also wanted to show you guys examples of trades I've entered. Unfortunately, I didn't enter many continuation trades towards the end of last year because, number one, last year wasn't great for continuation trades. There weren't that many because there weren't a lot of major trends. And number two, I wasn't trading towards the end of last year because I took a few weeks off towards the end of the year. I had an extended holiday. So that's why I'm struggling to show you guys continuation examples that I personally entered, just because there weren't that many, and the ones that were, I was on holiday. So again, this is an example entered by students of mine and not me personally. But I'll also show you guys some trades that I entered personally soon. So yeah, this is just another continuation example. You got a strong bearish trend. Price breaks through this support area, and you can see that it broke through here. Then quite a while later, it came back to the area. So it broke on the it took a while to break, but let's say the 27th was when it actually broke. It was a month before it made, almost a month before it made it back. So 27th of November to the 23rd of December. So it was always almost a month before it made it back, but that's still okay because it's still in a bearish trend. So, you know, even if it's a few weeks before price pushes back up to the resistance area, or in the case of a bullish trend to the pushes down to the support area, that's fine. It's still a continuation. So again, this is just a simple example because price pushes up to resistance. We get this candle here of price stalling on resistance, and the target, the entry was here. Stop loss goes above the high of the indecision candle, and you can have a pretty good target on this one of 1 to 2. Now, like with most continuation trades, you want to try and extend that target. In this case, extending the target wouldn't have done you much good. But you have to remember that last year was a period of low volatility, and extending targets last year wasn't really what you wanted to be doing. This year, I'm expecting higher volatility, so extending targets makes more sense this year. So yeah, that's another example. I'll show you guys a few more examples just so you kind of get the idea of these setups, and then we'll go on to some of the other setups. I actually want to show you guys a bad example. Well, not a bad example, just a failed trade. Because I hate to show just positive trades. New Zealand USD. Now, this is going back to 2018. Again, that's just because this is the last time that New Zealand USD was truly in a major trend that was giving good setups. It's just 2019 was, like I said, a year of some pretty significant ranges and not many trends. So that's why we have to go all the way back to find good examples. But these are particularly good examples. And I'm expecting more trends like this year. So these examples do apply. So 2018, we saw a big bearish trend on New Zealand USD. Price pulled back up to resistance. In this case, the trade, you know, you could technically say that this trade would have worked out. And I'm not sure if this support resistance area was actually here back then. I don't think it was. Oh, there it is. So your entry goes below the low of the indecision candle. Stop loss goes above the high. And your target goes at around about 2R. Even if it's through a support area, that's fine with continuation trades. Now, this trade, technically, had you stayed in it, you would have hit your target. But you would have had to hold this trade for 1, 2, 3, 4, 5 days. And there is a weekend in between too. So we're talking 7 days of holding this trade. This one you probably would have closed out with a minor loss, to be honest, because holding a trade for 7 days that's moving nowhere is not something I like to do. I prefer to get out of the trade and look for another setup. But regardless, so this isn't a great example. In terms of it probably wouldn't have been profitable, but I thought I'd show it to you anyway because I don't want to show you just good examples of trades that would have been profitable. Here is another example. Again, we have a bearish trend on New Zealand USD, pulls back up to resistance, stalls out on resistance. So we get that little indecision candle on the resistance area, Entry goes here, stop loss goes above the high, and your initial target goes at 2R, which is twice the size of the stop loss. And then you look to extend that target. In this scenario, if you look to extend that target, you probably would have been in the trade for a long time. But eventually it did push down. So again, this is one of those cases where it just depends how long you want to hold on to the trade. But anyway, this is another example, and just one more examples of a continuation trade, guys. This is a bit high. This is an example of a failed one, one that didn't work out. So again, price trending down on New Zealand USD. Price breaks through support, pulls back up to resistance, get pretty nice indecision candle. So once that indecision candle closes, you place the entry at the low of the indecision candle, you place a stop loss at the high. In this case, what would have happened is price would have initially started pushing down, triggering you into the trade, would have pulled back up and hit your stop loss. Perhaps you could have survived this one if your stop loss was a bit wide, which is something we often do. So this one just depends on where your stop loss was. You could have survived it, but realistically, with price moving against you for so long, you probably would have just closed this one out with a loss. Again, I want to show you guys some balanced examples, not just good ones. I think that's enough for continuations. I'm sure you guys get the basic concept. For more details on entries and how I do my stop losses, my entries, and my targets, check out some of my previous webinars. I'll link to them below this webinar. So going back over to the slides. I want to talk a little bit about breakout trades. Now, breakout trades, these are pretty new to my strategy, but I'm quite excited about these because they are some of the most profitable setups that I feel that these are going to be some of the most profitable setups this year, and they've already proven to be really good in January, and I'll show you some examples of those trades. So breakout trades are pretty simple. They occur on areas of support or resistance, and again, they're ones that you want to trade with the trend. They're best on the daily, but they're also valid on the 8-hour and the 12-hour. They're valid, like I said, only on pairs with a strong daily trend. You trade only the direction of the daily trend. Again, you always try to extend your target. This is very similar to continuations. You move your stop loss to break even after you hit 2R. Double tops and bottoms are also good. This example is a head and shoulders pattern, which I'm sure a lot of you guys are familiar with. But you can also trade these as double tops and double bottoms. So a breakout trade is essentially... can I draw on this or what? Why isn't it working? One sec, guys. Oh, now I can draw on it. Awesome. Yeah, so breakout trades, what we look for is double tops, double bottoms, or head and shoulders, or inverted head and shoulders. And we look for them on areas of support or resistance. We look for them to be in line with the major trend. So this example here shows a bearish trend. We then get a head and shoulders pattern forming on top of a support area. That's what I look for. I look for them to be on top of support or resistance areas. It's a little different to how most people trade head and shoulders patterns, but this is the way that works for me, and it works pretty well. So basically what's happening here from a price action standpoint is price is hitting the support area, testing the support area multiple times. So after it tests it multiple times, then we get price pushing to it again and breaking through it like it does here. We looked for a short trade from there. So I'll show you an example of some head and shoulders patterns. And I'll show you some recent examples of trades that were actually taken this year. And I actually shared these trades in my analysis on YouTube before they triggered. I shared them actually several days before they triggered. I said that I was looking for these setups here. So these are fresh examples, which I always prefer to show. Can you see my charts? Yeah, you can. Nice. So first we'll start with this head and shoulders pattern here. Like I said, this was a recent one that I shared in my analysis. Pretty simple setup. This one's depends on how you traded it. It's still open, or you could be closed out at break even, or you could have closed out with some profit. The thing with my strategy is once you get in a trade, you can decide what you want to do with that trade. Now, I have a set of rules that I follow, and I generally advise people to follow those rules. But you know, you always get people doing their own thing, which is fine, and it's actually great. That's what I ultimately want people to figure out their own thing. So when I say this trade could have been closed out, it could have been closed out at break even, or it could still be open depending on how you approached it. What I'm simply meaning with that is that some people have closed it out, some people have kept it open. It just depends on how specifically you want to deal with the trade. So anyway, what we have here is a overall bearish trend on Euro USD. It's not a strong bearish trend, and in fact, Euro USD, you could say that it might be starting to trend up this year, like I was talking about earlier. But overall, the trend is still very much bearish. If you zoom out on the daily chart, we can see that we are in a overall bearish trend. So in this bearish trend, we're looking for short trades. We're looking for breakouts to be short. We got this head and shoulders pattern forming here. Can I draw my charts? Yes, nice. We got this head and shoulders pattern forming here on top of this support area. So price broke through the resistance area, came back down, and once price breaks through a resistance area, it becomes support, came back to it, tested it as support, pushed up higher, then dropped back down again, tested it as support, pushed up again, then it got back down to here. Now, when it was coming back down, that's when I shared this in my analysis on YouTube, and I said, I let you guys know that there was a potential trade coming up. So price came back down to here. It stalled down on top of this area for a little while before breaking through. So when it broke through, that's when the setup becomes tradable. What I like to do personally is I like to wait for a close below the support area, and then I want to enter the trade on a pullback. So, oops, there's the wrong. So with this head and shoulders set up here, what we saw was price breaking through and closing below with this candle here. Once that happened, I look to enter this trade. So the way I do it is because I don't want to get in all the way down here because it's too low, I set an entry further up, hoping for a retrace. And if that retrace happens, then I'll enter the trade. My target goes, oops. My target, we'll start with my stop loss actually. My stop loss goes beyond the resistance area. So support broke, it became resistance. So my target goes beyond the resistance area. My stop loss goes beyond the resistance area. My target is usually at least 2R. And if 2R is met, then I try to extend that target. So this is a pretty simple setup. In this case, it didn't drop down further, but you have to remember that this was 28th, no, sorry, 31st was Friday. So this was the Friday candle. Now, what happened this Friday? Well, I'm not going to wait for you guys to answer because there's a bit of a delay on this thing. But what happened on this Friday was Brexit was finalized. So if you were in this trade, you should have closed it out before this Brexit finalization thing happened. Well, sorry, not finalization, but you know what I mean. Before this Brexit thing happened, you should have closed out the trade. So you really shouldn't have been in it for it to go all the way back up and hit your stop loss. You should have closed this one out with 2R. Usually we look to extend our targets, but in this case, because the Brexit thing was coming up, and that's obviously going to affect the euro, you don't really want to extend your target in this scenario. So this one would have been fine with a 2R target. I think some people didn't close out because they wanted to hold on to it, thinking that it was going to continue down, and they would have got stopped out at this stop loss. Some people, they moved their stop loss to break even and they held on to the trade. They would have got stopped out at break even. So it just depends how you approached this one. But in my opinion, you don't really want to hold through that Brexit news. Switching over to AUDUSD, this is another example of a head and shoulders that I shared in my analysis before it triggered. So I shared this trade before it triggered. We got price breaking through resistance, pulling back down after. So this was the resistance area. It broke through the resistance area. Resistance became support, came back down, tested support, pushed up higher, came back down, tested support again, pushed up again. And then you got that kind of head and shoulders formation that we're looking for. Price comes down to the support area and you get two indecision candles and then boom, it breaks through, closes below. So in this case, the close below wasn't that crazy. It wasn't as big as the close that we saw on Euro USD. So this one you could have just entered it if you wanted to. You didn't have to enter on a pullback because, yeah, there really was no need to. Again, you have your target at 2R. Once your 2R target is hit, you can look to extend it if you want to. So there's plenty of opportunity to extend this one. You could still be in this one if you really want to. You could have extended to 4R, and that 4R target is yet to be hit. So you could have your target down here at 4R. You could exit part of that position. Whatever you want to do. I'll leave the management up to you guys for now. I don't want to go into too much detail about trade management. That's something I'll leave to you guys because today we're just discussing the best setups to trade. So this is what I call breakout trading because we're trading breakouts from these support areas in line with the trend. So yeah, head and shoulders pattern. Let's go back to Euro USD real quick because there's an example of a double top here on Euro USD. Again, bearish trend on Euro USD. This is an example of a double top. So it's kind of like this M shape is what you look for, and a double bottom is a W shape. So price breaks through resistance. this is the resistance area. It breaks through resistance, pushes up, resistance becomes support, comes back down, tests it as support, goes back up, comes back down, and this time it breaks through and it closes below the support area. And once that happens, you can enter the short trade. So you enter after that candle closes below. Stop loss goes above the resistance area, and your target goes at around 2R, which would have been hit on this one. Yeah, it would have been hit on this one. I think that's it for these setups. We'll be discussing these setups more as the year goes on, and I'll be showing you guys a lot more examples of these setups in my analysis. Like I said, I shared the AUD USD and Euro USD one. I'll be sharing a lot more of these setups, and I'll be, letting you guys know when I see them, and I'll be explaining how I'm trading them and how I'm getting into them. Yeah, that's enough examples of these for now, because we're running short on time, and I want to jump into some counter trend reversals, because they are pretty important too. So counter trend trades are a bit. I've always traded counter to the trend. And a lot of people don't like trading counter to the trend, but I think it's fine if you do it in the right scenario. Now, this year, counter trend trading is going to be a little bit harder than it was last year. The reason is I'm expecting to see very big trends this year, and countering very big and very strong trends is kind of tough. But countering trends on the smaller time frames generally tends to be a whole lot easier, because your targets are quite tight and it's pretty easy for price to move enough to hit your targets on the smaller time frames. Now, counter trend trades, they're valid on all time frames, but take care not to counter very strong daily chart trends. If there's a very strong daily chart trend, you don't want to go against that trend on the 4-hour, 6-hour, 8-hour, 12-hour or daily chart counter trend this year. I just think that trends are going to be way too strong, and trying to counter trends on the larger time frames is going to be quite risky. Now, the 4-hour is kind of like an in-between. You could pull it off on the 4-hour if you want to, and for people who have a busy schedule, that's where you probably are going to be taking counter trend reversals, because it's going to be harder to trade the hourly charts. So you could technically do it on the 4-hour charts, but the risk is going to be higher and higher the bigger the time frame. And if it's a very strong trend, like I said, do not trade against it on the larger time frames this year. We're looking for trends stalling after big moves. That's important, and I'll show you guys some examples of this in a second. You want to keep your targets tight when you're trading counter trend. 1.5R, 2R maximum, and you want to give your stop some breathing room. That's kind of an important factor, and it's going to be very important this year, actually. So, oops, and I'll show you guys some counter trend trades, some examples of counter trend trades. I'll show you guys some positive ones, some failed ones, and yeah. So Euro USD, as I've already explained, Euro USD is trending down. It is in a bearish trend. Now, it's not a very strong bearish trend, like I said earlier. It's not a very strong bearish trend, because you can see since March 2019, it hasn't really moved down a whole lot. It has been moving down overall, but it's not a very, very strong trend. So trading counter trend on Euro USD right now is okay, because it's not a strong trend. What is a strong trend? This is a strong trend. Look at New Zealand USD in 2018. This is a strong trend. Trading counter trend on a trend this strong is a lot riskier. Trading counter trend on a trend like this is a lot easier, right? This isn't a strong bearish trend. It's a bearish trend, but it's not a strong one. So it's pretty safe to trade counter trend on Euro USD right now. And there's quite a few examples of counter trend trades on Euro USD. This is one of them. This is on the daily, but you could have also traded this one on the 12-hour. It depends what time frame you wanted to go for. So the trend is bearish. We're trading bullish, hence counter trend. What we look for in a counter trend trade is, don't worry about that first blue line. I didn't need to place that one. What we're looking for with counter trend trades is essentially just that V shape. We're looking for price to push down, hit support. If we're looking for a bullish trade, push down, hit support, and then we want to go long. So in this case, price push down, it hit support. We got a nice little indecision candle on support on the 12-hour. This trade could have been entered. Oops. The setup, the entry could have been placed here for this setup. Stop loss would have been placed below the low, the most recent low, which would have been the low of this candle. And the target would have been placed up near this resistance area. Or if you wanted a tighter target, you could have placed it at the minimum that I use for these setups, which is 1.5R. But I always try to target 2R if I can. This trade would have been closed out pretty strictly with 2R. The only scenario in which one of these trades is not closed out is if it's moving really quickly in your direction. Then it might make sense to leave it open. But in this case, you would have had this trade open for quite some time where it was moving sideways before it pushed up and hit your target. So more likely than not, most people would have closed this trade out as soon as it hit target. Wouldn't have extended it beyond this resistance area. Obviously, if they did, it would have been profitable. But just because it would have been profitable in this specific case, you know, don't get carried away with setting big targets on these counter trend trades. Because sometimes, sure, if you set a big target, it will hit your target. But most times, these counter trend trades do not move like this one. They don't push up as far as this one. So overall, it is better to have a target of either 1.5 times the size of your stop or 2 times the size of your stop, and just get out there. Here's another example of a counter trend reversal on Euro USD. Now this one was part of the head and shoulders pattern that we were just looking at. When the head and shoulders pattern came down to this support area, it stalled out for quite some time. Now, when it stalled out there, because it hadn't broken yet and giving us the short for the head and shoulders, it looked for a while like it might turn around and go up. Now, honestly, I didn't... wait, did I? I'm pretty sure I strongly recommended not to take this trade, but technically speaking, it was a counter trend reversal, and some people did take it. Some people took it, so I'm going to show you guys the example anyway. Obviously, it was a failed trade. It didn't work out, but we've got indecision on top of the support area. So the entry goes above the high of indecision. The stop loss goes below the low of indecision. The target goes, you know, up here at 2R, or if you want a tighter target, you can have it at 1.5. Obviously, this one didn't work out. It pushed up, and then it continued down, and it turned into a decent head and shoulders setup, which I explained earlier. Yeah, that's 2 examples on Euro. Yeah, let's just do a few more quick examples of these kind of counter trend trades, and then we'll wrap this webinar up and we'll do a bit of a Q&A. So this is GBPUSD. We got some counter trend trades here. I think this is one good one and one bad one. So, oops. Price started trending up on GBPUSD towards, the end-ish of last year. Price started trending up. And there was a few counter trend trades here in November. First one was this one, and second one was here. So I'll explain exactly how these trades are traded. So they're counter trend because it's a bullish trend, and a bearish trade from resistance in a bullish trend is a counter trend trade. Indecision forms on resistance. You place your entry below the low of indecision. You place your stop loss above the high. You place your target at 1.5 or 2R. 1.5 if you want to play it safe. 2R if you want to have a bigger profit, but it's obviously a bigger risk. This trade would have worked out quite well. It would have hit target pretty easily. It would have stopped at the support area, and then it would have turned around. So there was a second opportunity to enter this as a counter trend trade here. Now, this one did not work out as well. It was a riskier setup. We got indecision on resistance. Stop loss goes above the high, or the most recent high, which is the high of this candle. Entry goes here. Target goes at 1.5R because that's 1.5R at the next support area. This one didn't work out. It pushed down, got kind of close, and then turned around, and eventually kept going in the direction of the trend. That's always a risk when you're trading counter trend, that you enter the trade and it goes in the direction of the trend and not in your favor. But there's a risk to every single trade you take. Counter trend trading overall is profitable. So there's no reason not to counter trend trade because it is overall profitable. But it definitely is higher risk than the other setups I was showing you. I think that's it for the examples, guys. I've gone through a lot of examples. For more details on how I actually take these trades, check out my analysis, which I do for the public every Tuesday and Thursday. Also check out some of my former webinars, some of my past webinars, which I'll be linking to below this video. That will give you a better idea of how I enter these setups. Like I said, today I just wanted to talk about the setups I will be focusing on. The entry criteria and stuff takes a long time to explain, so there's separate webinars for that. I'll also be doing some webinars next month. I'll be doing several webinars next month in which I go into a lot of detail on support resistance areas, entries, and all that kind of good stuff. So watch the recordings, which I link to below, and that should get you through the next month. And then towards the end of this month, I'll be doing, or at the start of next month, I'll be doing another webinar series where I'll give you the most up-to-date way that I enter trades and all that good stuff. So anyway, guys, I'm going to wrap this webinar up, do a quick Q&A, and then I'm going to get out of here. So do you guys have any questions? I wasn't really paying attention to the chat, so if you guys were asking anything during the webinar, I wasn't looking at the chat. I try not to look at the chat during the webinar, as it can get pretty distracting. Yes, there will be a recording. Yeah, it'll be posted on YouTube. I'll be doing the recording very quickly after this webinar ends. What is my take on AUD/USD? Well, like I said, there's currently an open short trade on this pair for this head and shoulders pattern here that I shared last week with you guys. So, well, it depends. Some people close this out with 2R. It depends how you traded it. This one could still be open. I mean, AUD/USD has just broken a major support area, and it's tried to get back through this support area, which has now become resistance, and it's failing. I wouldn't be surprised if it continues down from here, but it's just way too early to say. The thing is, when price hits these major lows, sometimes it will just start to consolidate at these levels for a few days, and then it'll turn around and go up. I wouldn't be surprised if we see that either. So my take on AUD/USD right now is it could go either way. I think the coronavirus is definitely having an impact on AUD. It's obviously having an impact on China, and the AUD is affected by the Chinese currency and by the Chinese economy. The AUD is affected by it. So, from the coronavirus standpoint, it wouldn't surprise me if we continue to see weakness in the Aussie dollar. But it is at some extreme lows that we haven't seen since going back to the weekly. That we haven't seen since before this time, before 2019. Oh, wait. Yeah, here it is. 2009. All the way back in 2009, it was at these lows. But right now, it's not. Right now, it's not that low, but it's getting there. It's getting there. In 2009, it was hovering around the 65-cent mark most of that year. It was up and down. It obviously went all the way down to the 62-cent mark, but it was hovering around the 65-cent mark most of that year. And we're pretty close now. We're at 67 cents. Yeah, I mean, that's my take on it. My take is it could go either way. I'm not convinced on either direction right now. I think the coronavirus is having a big impact on the Aussie. It's causing weakness on it. I think that's one of the biggest reasons it's moving down. Daniel, what do you think about the coronavirus? Will it affect the markets for how long? Honestly, the coronavirus thing, it's been blown, as far as I can tell right now, and I'm obviously not an expert on these things, but as far as I can tell right now, a lot of it is just media hype, and it's been blown completely out of proportion. And they're making it sound like it's the end of the world when it's, in reality, just a pretty bad flu. So, as with most of these things, and I've been through a lot of these things in the past in my trading career. Like, I think the most recent one before this was swine flu, or was it Ebola? I can't remember if Ebola was after or before swine flu. It doesn't really matter, but we had Ebola, we had swine flu. We have these things happening quite often these days, and they never tend to last long. They always tend to blow over. The market impact they have is generally minimal. And it only lasts a few weeks until the media finds something else to talk about, and they let this story die. So, yeah, I'm not too worried about it. Richard, that's a good question. Do I trade breakouts only on patterns, heads and shoulders? Heads and shoulders, double tops, double bottoms. Those are the kind of breakouts I mostly look for. There are a few other breakout setups that I'm going to be adding to my strategy, but those ones are for members only. Members of my Forex Mastermind course. I try to strike a bit of a balance between setups that I share publicly and setups that I keep for members only. The more advanced breakout patterns that we will be trading this year are going to be for members only. Yeah, Charles, I'll be sharing links below this video. It will be in the description of this video. It's not up yet, but it will be. What's my take on New Zealand pairs stalling on resistance? I never really know how to answer these questions when someone says, what's my take on something? I'm the kind of trader that trades when... What the hell happened to my support resistance areas for this pair? These support resistance areas aren't right. Oh, okay, never mind. I know why. Because I was moving them around for the... to get them close to what they were back in 2018 for the examples. I'm going to switch back to my real charts. Because that was just like a profile for the webinar. Right, so these are the most up-to-date support resistance areas for New Zealand USD. I mean, New Zealand USD is not really stalling on support. It looks like it's broken support. I've got no idea what long position you're in, and I'm definitely not saying hold on to it because I don't know what the trade is. I don't know what your entry was. I don't know why you entered. I got no idea. Philip, you must have missed the whole start of this webinar because I said about 5,000 times in this webinar that I'm expecting a lot of trends this year. Right, guys. I'm going to wrap this one up. I think I've answered all the questions. Yeah, I think I've answered all the questions. I'm going to wrap this webinar up. Thank you guys very much for attending. And Igar, I don't understand. I definitely did not tell you to hold on to a position on AUDUSD. I didn't even know you were in a position on AUDUSD. And I definitely didn't say hold on to your position on AUDUSD. I think you're reading into... I think you're in a long trade and you want to hear me say to hold on to the trade. So that's what you heard me say, but I never said that. I think that's... I don't think that is a good trade, personally. Well, actually, I'm not going to say I don't think it's a good trade. What I'm going to say is the trade doesn't fit any criteria I have for a trade. So I would not be in the trade. But I can't tell you whether to hold on to the trade because I don't know what the reason for entry is. I don't really know anything about that setup. If you're looking for someone to tell you to hold on to a trade or close a trade, then you should probably just close it because you shouldn't really be trading. It's clear that you don't have confidence in your own trading, and that's not a position you want to be in. You don't want to be looking for someone to tell you you should hold on, you should get out. You should know exactly what you're going to do with your trade. You should have a game plan for each and every trade you're in, and you should know how to handle your trades. You don't look for people like me to tell you what to do with your trades. So in my opinion, you should close it out, reassess what you're doing with your trading, and reassess your strategy, because it's clearly not in a good place right now. So I hope that answers your question, Igor. Sorry if it sounds harsh, but I'm just being honest, because if you're asking some guy doing a webinar on YouTube what you should do with your setup, it's clear that you're just not in the right frame of mind, the right psychology. You don't have a concrete strategy. You don't have a concrete plan. You don't have a risk management plan at all. It's clear that you don't have any of these things. And ultimately, when you don't have any of those things, you should not actually be in the market, because that's how you lose money in this market. And that's the problem with trading. It's been made so accessible that everyone thinks that they can do it, and the reality is it's not as easy as most people think. Anyway, I've been rambling on about this for too long. Get out of your trade if you can get out of break even, and try to figure out what you want to do with your trading in general. So yeah, thank you guys, and I'll see you for the next webinar, which is going to be next month.